Hello, my name is Michael Glass from emini-trading-coach.com, where we focus on trading high probability trading setups. Before we begin our video, we want to talk about our disclosures. Any symbols you see today should not be inferred as a trader recommendation. No matter what form of investing you choose, stock, forex, futures, options, they all have a level of risk associated with them. You can't lose your money. Any back testing of strategies, setups should be viewed as hypothetical. Future results are not guaranteed. Any investments that you make is solely your own responsibility. Trade at your own risk. So we're going to look at the week that was for Saturday, March 5th, 2011. When we look at last week, we see that all three major indices did end up very slightly for the year, for the week, up 5% for the year, 39, 3, 1, all fractionally up for the week. Oil prices hit two-year highs, gold hit a record high, and again, the market was flat. Why? Well, we continue to have turmoil over in Libya, which affected the price of oil. The only real corporate news we had this week that really moved the market is the iPad 2 that Apple unveiled this week. On the economic front, Bernanke gave some positive outlook testimony on his semi-annual policy report. Friday, we had good news from the non-farm payroll. Unemployment ticked down. We had some jobs added, but I think it was muted because of Thursday's huge move, probably a move in anticipation of the report, and we had a sell the news reaction to Friday's numbers. So when we look going into next week, there's no real major earnings coming up next week. And nothing really on the economic count either that's really going to move the market. So as the market has been pausing now for about a week, 2 weeks, it's going to be real interesting to see that as we don't continue to have no catalyst where we're going to go. Again, obviously we're still in an uptrend, so therefore we still buy the dips. You buy the dips until it's not working anymore. Confirmation is we have our last swing high was around 1344. Our resistance, however, long-term resistance is up there in the 1350s. And our support is right where we are, about 1312. We got the 50 XMA below us. 10 XMA is also sort of below us. And the interest is going to be 1332. That's the kind of the swing highs we made over the past week. Let's pull up a chart and take a look. Okay, so here we are looking at a daily chart of the S&P 500. And you can see here we are in sort of a 2-week lull here. We had this beautiful uptrend from November, actually longer, but November was like the really last big pullback. And you see we had a little 2-week pullback here, and that is the November pullback that we're referring to. So what we want to see is whether or not this 2-week lull here is going to resolve itself to the upside. We got resistance here after 1350 that we talked about. We got our last swing high here, 1344. Will we resolve higher, or are we going to finally break the 50 moving average? Here, when we came down, we tested the 50 moving average here, and now here we are sitting right here. Will we resolve ourselves higher? Now let me see if I can blow this up one more time. And now you can see my point of interest at this 1332 price level right here. And matches up with this little swing high here. Wicks for the past couple weeks have come up here to this 1332 price level, and we have fallen down. So I think if we break this, certainly we'll retest at 1344 and possibly have enough to move up here to the 1350 price level. But right now, our resistance, we're finding good resistance here in this 1332 price level. When we look at our indicators, we can see that they're coming out of overbought, and stochastics are coming back up. But for the most part, at least we're finally coming out of overbought, and maybe we'll get down here to oversold. Certainly more pullback needs to happen to get that, or at least a little bit more pausing, and maybe actually coming and hitting the 50 moving average. But at least we've finally gotten out of the overbought level. As we pull back to the weekly, we can see where we pulled this 1350 from some swing highs and lows way back in, I believe, 2008. But our indicators, what we really want to look at is that they are still overbought. Our weekly indicators are still overbought, even with this 2 week sort of pullback pause, and we got an indecision doji here on the weekly. Also look at the 10 moving average here on the weekly and see, and that's all the way down at 1298. That certainly would also confirm by the dips. When do we start selling rallies? Maybe down here below 1300. Let's take another snapshot out. On the monthly, again, clearly seeing where we're getting our 1350 for. And our monthly finally giving us a stochastic sell. MACD and RSI have been hovering at overbought. So again, cautiously bullish, pullback, probably continuation is certainly in line, but we want to see some moving averages and support hold. Otherwise, our mindset has to change from uptrend to sideways to down. Okay, so now we're going to go ahead and take a look at our industry leaders, our market movers. Starting off with Apple. What we talked about last week was Apple above the 20 moving average was a buy, and you see we got that. And obviously what we have to look at right now is that Apple is coming into its previous high, and so we have a double top setting up here, so we have to be very cautious. Now on the smaller time frame, we can see that we have a breakout going on here, especially at the end of the day, saying that this move up could continue, and certainly that our longer time frame and our shorter time frame are agreeing. However, I would be very cautious because, again, of this double top setup. I mean, we tried to get to 365 and sold off there. So you may get a quick move, but right now I would hold off on Apple and see some type of confirmation above 365, or I'd be watching for the double top. I would be watching for maybe a breakdown below the 20 moving average. A break of 350 might say we have a lower high in and the momentum has changed. Let's go to Amazon. And Amazon is trying its best to put in a double bottom here. Already put in a double top that Apple may be putting in here. And it's trying to hold on to the 170 price level. The 20 moving average is actually breaking below the 50. So we could possibly have a continuation of this move. The problem is there's a lot of wicks going on here, a lot of wicks, and I would feel better going short below these wicks, which is down here in a 168. So I'm not quite ready. Maybe if you would have taken advantage of the double top and shorted it up here. But right now, these people who shorted up here, they're getting out, and the people shorting here are going to have to sit through any consolidation. So we need to shake these people out before it's going to go a little bit lower. So our shorter time frame is actually turning bullish here, showing maybe we'll go up and retest the moving averages. So that's kind of the way I look at Amazon. I would like to see it come back up to the 20 and 50 here, maybe short a failure, or maybe go long if we're actually able to break above and confirm that we're going to go back and retest the 190 highs. Google. I believe last week I said I didn't really see the trade, and I'm probably going to say the same thing. Maybe, just maybe, a break of 600 may give us a short. Let's zoom in here. But we got these wicks here that makes me even cautious of a break of 600. That will get our 20 below the 50 moving average. I put an alert there. I put an alert below 600. But again, these wicks here all the way down here at 595 have me concerned that it's going to break it and then just whip on out. Yeah. But I still think you can put an alert around 599, 600 to see what happens. We are in a downtrend, short term, uptrend, long term. So we can see if we can get some confirmation. Goldman Sachs has the news about one of the persons that used to be on the chairman of the board, and I believe it was on Procter and Gamble, and another person charged with insider trading this week. We know the financials lead the S&P 500, and you can kind of see the same thing. And I guess we're going to see this across the board, is that we see a lot of consolidation going on here. And so maybe a break of 160 can get us a little wiggle room down to 156. Now, the thing that's different about Goldman Sachs is that Google can whip you $5 with the blink of an eye. Goldman Sachs isn't really going to do that so much. So the fact that the next support down here, 155, 156, doesn't concern me. I wouldn't mind playing that $4 range. So I would look to short Goldman Sachs below 160, below 160. Oops. Going to finally Netflix, which has been on a tear, and Netflix trying to find support at the 50 moving average. Hovered here for a couple days, bouncing. I guess, yes, I would go long above the 20, above 213. I would certainly go long to retest the highs. Short, I would say you can go below these wicks and see if we can come down here and retest the 180 price level. So I would put an alert below 200, above 214 for Netflix. So what we're seeing with our industry leaders is what? A lot of consolidation. No real clear bullish trade except for Apple. So we have to watch. If our leaders are starting to go weak, then that obviously is going to pull the market down with it. Okay, as we move on to the education portion of our video, we're using the book Trade Your Way to Financial Freedom by Dr. Van Tharp. And we're on chapter 8, talking about market timing and common entry techniques. And one of the most popular entry techniques are channel breakouts. But one of the things that you'll find, and they were made famous by the turtle traders, trading 20-day breakouts and eventually the 40-day breakouts. But what you'll find is that trading breakouts really takes a larger account because you can get whipsawed. It takes time. In one of our videos, we talk about when you buy a high, then you're typically going to have to wait for that consolidation back down to a support area and then let it come back up and then go higher. So when you're buying the high, you tend to have to wait instead of just buying from a support area and letting the momentum take you up and breaking you out. So breakouts are not that much different than a random entry because the market tends to like to pause and digest. However, you can look for, I like to trade swing highs and swing lows on an intraday basis because I don't have a longer term time frame. On a longer time frame, we want to make sure we have volume coming in and maybe some momentum coming in with some other indicators if we're going to trade the breakouts. However, as we just said, you probably want to make sure you're looking at buying from a support area and let the momentum take you to the breakout versus just buying the breakout alone. As you know, we're on Facebook, YouTube, and Twitter. We've got a great free video for you on how to develop your high probability trading setup, which will be an introduction to our video curriculum. $250, not $1,500, $3,000. It's 3 videos broken down into 3 areas. All the components of trading, technical analysis, chart patterns, trading systems, and then the trading components, and then all the setups. But you know that the reason why we're not charging $1,500 is we want you to focus on you. We want to focus on you developing a trader's mindset, which will allow you to enact a trading plan of successful traders. Until you have that right mindset for trading, you're not going to be consistent, and you're going to be up and down and possibly blowing out your accounts on a regular basis. We still have a great relationship with Global Futures. 20 free trades, intraday margin as low as $300 if you sign up through us. And we have our new Forex blog, Your Forex Riches. The same great technical analysis you find here at Emini-Trading-Coach. We apply that to Forex. So you guys know it doesn't make a difference about the system, the indicators, or the room that you're in. It's always interesting to be in a room and see some people losing money, some people winning money off the same trades. But that's because you don't have the trader's mindset. You got to be able to pull the trigger on your trades that are for you, that fit who you are. And we at Emini-Trading-Coach help you do that. Thanks, guys, and I'll see you next time.